Good morning and welcome to your macro outlook for Tuesday, September 15th, 2020. Patrick Ceresna here. Let's just jump right into the charts. S&P 500 up just over 20 points, just above yesterday's highs, and continues to do a retracing bounce higher. When I put this on a 4-hour chart, you can see an intraday little double bottom, and more or less the market has been gravitating higher for the last couple of days. So is this it? So there are two news dynamics or two dynamics that are in play into the tail end of the week. So we are in mid-month. We have the Fed coming out on Wednesday. It's entirely possible that the Fed becomes a catalyst for a bigger market move. And then we have to deal with a gamma pin going into Friday's big quad witching expiration. And so if we don't see a big reaction on the Fed, it's entirely possible that the market is going to muddle for the rest of the week, and it's next week that we see the big move. This in itself creates a small complication in that we have to just simply deal with our SPY call hedge that expires on Friday. So at this stage with the market rallying, it's just building intrinsic value, and we'll be able to manage it accordingly. But the point that I want to really just have a bigger debate on is this simply a market correction, and are we imminently going to see a market rally, or is this the big one? And this is a fascinating question to answer. So I have the 50-day and the 200-day moving average on here, and you can see the 50-day has done a great job holding this sell-off, which characterizes it very much as a market correction to date. It doesn't mean it can't manifest into some bigger market spill, which would require some more follow-through selling to really trigger that feedback mechanism that creates liquidity events. But I want to really stop and reflect on these two up days and just put this in context. So let's just go back to this market correction right over here. And let's just look at past market corrections for context. So here we had a sell-off. That sell-off was more or less about a 300 S&P point drop, and most of it in one day. And then I want everyone to observe the two candles up, these two right here. And over a span of two candles, 48 hours, there was a 226 point rally, right, in 2 days. You can see that even now, the current rally has nowhere near the intensity of the bounce there. But then I want everyone to see what happened after the 2-day bounce. After the 2-day bounce, the market just spent a week just muddling, held above its 50-day, and it ended up just establishing itself as a market correction. So could we see similar style echo of pattern where, for instance, we just have a further update today on the Fed, we kind of sell, and then into the gamma pin, the market just muddles. And then sometime next week, either a rally happens or a breakdown. That is entirely possible. I want to just go back and look at some of the prior market corrections in the past. Now, notice here, these are the 2019 market corrections. Interestingly, rather than holding the 50-day moving averages, the theme of 2019 was that they would all stall at the 200-day moving average. With that said, notice, let's start with the zigzag. So back in April and May of 2019, there was the zigzag, and the zigzag is two equal length market corrections that occur downwards. I want to focus on the three candles right in here. Similarly, back in 2019, 3 days of market bouncing that ended up being about 100 S&P point rally from bottom to top. And then it zigzagged downwards into the correction. Similarly here, look at the correction that happened in July of 2019, where in a span of about 3-4 days, the market wipes out about 250 S&P points. It goes all the way down to the 200-day moving average. And then look at the 3-day rally that ensued. in 3 days, the market proceeds to rally 167 S&P points in just 3 days, coming back toward that 50-day moving average back then, and then stayed in the sideways trade range for over a month, right? So this entire market correction took, 3 weeks. This entire market correction before the rally started took about 3 weeks, 21 bars, a little bit more than that actually, because those are daily bars. So that's about a month. And then look at this market correction. And this is also a very interesting one. Similarly, this market correction had a 2-day drop, almost 3-day drop of about 140 S&P points. The 2-day rally that followed was about 120 S&P points, and then it consolidated for about 3-4 days and then rallied. And so this is what market corrections look like. So the way I would put it is this: the longer this market takes to break down and the more it's trading sideways and creating a base, the more we have to entertain the idea that this will be a buy on dip, that the bulls will prevail in holding the correction, and we have to be looking for a bullish breakout on the upside. But I'm not going to make a flip-flop call 2 days into a bounce. Look at, like, the point I was trying to get across here is that there is distinctly during all market corrections the reaction, and these reactions last 2 to 3 days, and then they give it back, or they retrace. So the point I want to make is that we're not going to turn around and flip bullish just because there's a 2 or 3 day little bounce. And similarly here, if you look at before the and I think that looking at the Christmas massacre is a really interesting correction, because you can see here that this initial breakdown, and this is amazing because almost all of these corrections blow through their 50-day moving average and all seem to at minimum retest the 200-day, or in this case break decisively below the 200-day. You can see we're nowhere near doing something of that nature, and that's largely because the S&P was from such a high starting point. The point here is that again, another market drop, and look, 3 days of market rallying that basically had the market bounce back 100 S&P points off of its lows. It is an incredibly natural reaction for the markets to react off of such a sequence of selling. To date, or up till now, from the bottom to top, the rally has been 105 points. But the rally's been 105 points after a 300-point drop. And so it is still nothing to write home about. It's right now there's no reason for us to change our narrative, and I think that's the best way for us to sum this up. So here, looking at the 4-hour, if I just do a Fibonacci of the whole market correction, you can still see that would it be out of line between today and the Fed meeting that the market somehow pokes around towards the retracement zones and then reacts in a bad way off the Fed. I mean, that's entirely possible, and we're going to be watching to see what happens here. One of the big things for me that I'm debating is if we do get a shoot up to 34.50 or higher, do we pull that 335 call hedge? And the answer is yes, because it has a Friday expiration. We're not going to dilly-dally. If we get a surge up into that fib zones, you shouldn't even be waiting for my alert. You should up anywhere around 34.50 on the SPOOs. You're going to need to entertain the idea of covering the hedge and just keeping the original straddle as is. Okay, so let's just quickly go through the other charts. Dollar, this is actually the big tell, right? For an inverted head and shoulders, you have to create the right shoulder, and the right shoulder has to go back and retest similar zones as all of these prior shoulders. And so and notice that works out as with the fibs. And so the big tell is coming as we approach this zone, and that will be where if it's bought on dip on the turn, we're in good shape. So really, though, I want to just touch on where's the one currency that's just not confirming this at all, and that's the renminbi. The Chinese yuan has decisively broken again to the downside, and or the U.S. dollar is broken against the yuan, and you have a very clear move. The other currency that's moving right now is the U.S. dollar yen. We've been talking about how tight of a trade range this has been, and we have here this very very tight range, and it's breaking to the downside. And so, is this a real breakdown? Now, we were biased for the US dollar up. It's coming to some previous lows, but this is worth watching because it's a potential start move. And so, we're going to see what happens here. Anyway, that's what I want all of you to keep on your radar. Very quickly, Bitcoin rallying here. It's interesting. I don't want to shit on this breakout because gold and other things are breaking out with the US dollar weakening. Maybe they will try to buy on dip this. What will be impressive is if, not impressive, but what would be the first constructive thing is that if they can clear fib zones. Right now, as they approach 11,000, it's just approaching the Fibonacci retracement area. If it rejects and turns around and heads back to 10,000, it's nothing to write home about. It needs to start clearing the fib zones to show that things are bullish. Very quickly on crude oil. Was that enough selling? We are waiting for I'd love to buy the dip into the mid to low 30s, but we also have to have a game plan if it never happens. I'm bullish oil. I think that this is going to prove to being the opportunity to buy the dip. And so the question, should one start buying operations here and then just double down there? I mean, this is where tactical short-term hedges come in play. I mean, in theory, if you bought oil here and you just bought a week or two of protection, knowing that if it slams down there, you can roll down and monetize the hedge and then be long off of a lower base and having improved your position, or you leg in, which is you buy one part of your position and wait to add to weakness, or if it turns, at least you have some skin in the game and you can turn around and work off of it. Anyway, I still believe a buy on dip is happening. My target and ideal zone where I'll push a lot more chips in will be down over here. Now, I already have a number of energy companies that I certainly don't want to say I'm on the sidelines in energy, but where I'm really looking at adding to this play, it would be somewhere in the Fibonacci zones. And often these zigzag, which is your first leg, it kind of pauses to the upside to the point B, and then there's one quick drop, and that drop is the buy on dip. Let's see whether or not that actually presents itself that way. Gasoline has been pulling back. I still think there'll be a buy on dip. Natural gas has been pulling back. I still think this is a buy on dip. I'm bullish on all of these, and I think that they're all an opportunity. Copper setting up for a potential breakout. Will it happen? And there's some members that are sending me data that are showing that things are a little overextended. Some of the correlations aren't lining up for this. But right now, from the price action alone, there is nothing bearish I can say about this on a 4-hour chart basis. Let me just break this down. This has been a sideways consolidation, and copper is attempting to break out. And if so, will it break out? And so I want to just show two measured moves. The midpoint measured move off this flag, and this measured move right over here off this consolidation. All target about 3.25. So either we're going to see a failure to break out, which is going to form some sort of topping formations, or we're going to get one quick surge that's going to add 10 to 15 cents on the upside on copper, and then we could potentially see a bigger consolidation happen off of there. But right now, it does feel like that. I feel almost like we need to roll up our entire hedge on Freeport. We'll talk more about it in Where's the Trade. Uranium buying on dip is something now it may still dip a little bit more. A lot of times these are equally proportional moves on the AB equals CD, but at this stage, anywhere down in this 4 to 450 range is an accumulation point. I like it. So will gold and silver break out? I love this. Like, look, we got faked out on the last breakout, but that doesn't mean that gold hasn't behaved incredibly well. For all the characteristics that we look for, it just observe the way it's holding above its 50-day moving average. The entire triangle formation has played out that way. It's attempting to break out, and more importantly, the gold miners have done the same, held above their 50-day moving averages, and we're again attempting to break out. Do we attempt to break to catch this move again? Absolutely. You know what? The I would rather get in and then have to manage a hedge out of the trade or something like this and do it repetitively. And even though that might happen, it's like you just can't be on the sideline if the next major leg higher starts. Like if the next major move starts and we talked our way out of taking the position, then we'll feel like a deer in headlights for not having skin in the game. I feel that these breakout attempts need to have a position. You need to have a position in them. If they don't, you trade your way out of the position or have some sort of hedge to manage it. But the way I look at it, you have to be positioned in this. Silver looking like it's going to break out. The grains pulling back like wheat. I think it's a buy on dip. The corn is finally stalling a little bit, but that's not any candle to write home about. Soybean has been the best performing. We just are talking with Angie, the goddess of grain, to coming on to the show on Friday for the market huddle. So we're going to get an update on the grains. Looking forward to that. We can talk more about that then. Anyway, Treasury bonds are just muddled because the stock market is just not doing anything, not yet anyway. And so when we look at that 10-year Treasury yield, it's exactly that. It's stuck in this range, and we still have not seen any big decisive move. I wish I could say something more. And in regards to most of the other markets like Nasdaq, look, I mean that again, like we could see fib retraces on these things. Notice that we're nowhere near the fib zones. There could still be 1 or 2 more days of upsurging on these things, but at this stage, we're not seeing anything that's saying that the bulls are back in business. All we have is an oversold market that it was overdue for a bounce, and it's bouncing off of off of the 50-day moving average. The European markets are flat. The Nikkei stalling, but still looks like a relatively bullish chart. And so, I mean, look, there's a lot of interesting things happening. Volatility continues to contract, which makes it easy for us to put on a lot of these trades where we're not overpaying crazy amounts of volatility. Anyway, we'll continue the conversation during the Where's the Trade. We'll see you all online then.